Hi, I'm James Davidson with Davidson Law Group, and today I'm here with John Morrison with the Morrison Firm. And John owns a CPA practice here in Texas and services clients all throughout the state and the nation. And John has a very unique practice, and I'd like for him in a moment to tell us a little bit about that. But he holds several different licenses: a certified public accountant, certified valuation analyst, and real estate broker. So John, tell us a little bit about your practice and the types of clients that you serve.
Yeah, thanks for having me, James. Yeah, so the Morrison Firm is a unique business consulting practice with the various licensing and the background that I and my staff hold. We like to think about our practice as a three-legged stool. One of the legs is business valuations and litigation support, where we can come in and analyze certain intangibles for a business, identify certain economic attributes, and really help business owners understand some of what's going on with their business behind the scenes. That can take a lot of different forms, from purchasing a business, selling a business, things of that nature. One of the other pieces with my specific background, some of my staff, working at highest levels of the corporate finance world, as well as leadership in some government roles. We have faced many of the same questions and concerns and worked through some of the problems as small business owners. And so we really are in a unique position as public accounting consulting firms, because we've been on the same side of the table and made those tough decisions. It's the same as the business owners. Mm-hmm. And so we really feel like that puts us in a unique position because we've been in their shoes. And of course, all of our clients and their stakeholders are at the end of the day taxpayers. And so with tax being such a large concern, large expense, we do some advanced tax planning and really strive to meet our clients on the front end to put them in the best situation possible to implement tax strategies.
Thank you, John. And today we're going to be covering some common questions that business owners face, and hopefully provide some value to you in those answers. So John, a lot of my clients are small business owners, and they oftentimes have questions for me about certain parts of their business. So today I'd like to talk about some of those considerations. And first of all, John, when do you need to start planning for the selling of your business?
Well, James, what I tell people is, much like your home, nobody's house is ready for an open house today to sell. Businesses, in a lot of ways, it's worse because you can't walk in and see that something needs to be painted or we need to replace the floor. It really takes a deeper dive, and you can rest assured that if you have a business of any size, the buyer is likely to be sophisticated and come in and ask you those questions. And really, honestly, nothing's worse than having someone pull back the curtain and see something that gives them pause, mm-hmm. because oftentimes, in my experience, that's the death knell. The very first thing they find that you haven't brought to the surface is the end of the conversation. Okay. So in that vein, it generally takes about a year to prepare a business for sale, and then oftentimes another year to actually effect that sale. So it's never too early to start planning.
Okay. So what would you say to those clients who might say to themselves, well, I just really don't want to get this started because it's too complex, or it's too intimidating, or it's going to be too time consuming?
Well, once again, when I tell people, back to the idea that this is likely your biggest financial asset. It is going to take some time. It is going to take some effort. A lot of times you have to work even harder during the sale of a business, because you have to keep everything just like when your home is for sale, you've got to make sure you pick up all the clothes. You got to make sure the kids haven't left their toothbrush on the counter, and you got to make it look as good as possible. So during that time, you'll be running the business. You'll be trying to make all your metrics look as good as possible, and you'll be working with potential buyers and other people who would be involved in the sale, bankers and things of that nature. So there'll be a great need to be able to produce more information. And so what I say is, with that and the planning aspect of things, that's what it's really important to have the right team in place, mm-hmm. who can proactively tell you so that you can plan for, these are the questions you'll be asked, this is the information we'll need to provide, and here's how we need to set you up, most likely with a package, so that when information is requested, you're there and ready to answer those questions.
And that's what I was going to ask you next. How important is it throughout this process, from beginning to end, to have good, sound advice or counsel?
It's critical, and it's really a team approach. I mean, it's extremely important to have a good financial advisor on your side, the CPA. It's really important to have that insight on the upfront in terms of the value and understanding how your business would be valued. It's extremely important to have a qualified attorney on the team, because at the end of the day, everything you're doing and the affecting of this transfer or the sale, it's a lot of legal considerations going into that.
Thank you, John. So John, one thing that I've noticed is that oftentimes small business owners are do-it-yourselfers. Because of their time, toil, and talent, they've gotten to the place that they are now. What would you say to a small business owner who would venture out to take on this process of selling their business on their own without a team?
Well, one of the things I like to tell business owners is I have a heart. I've had one since the day I was born. But I wouldn't do heart surgery. There's people specially trained in that. And so even though I've known my heart for a long time and it's beat within inside me, I wouldn't know how to give anyone heart surgery of any kind, or more than, I guess, a Band-Aid probably in terms of treatment. And so it comes back to the idea of specialized training and people forming a team of people who are good at what they do to help. Really, at the end of the day, you want to make sure, like in other business transactions, the process or thing you think you're about to accomplish is actually what happens.
Mm-hmm. Good. And so what are some of the taxation considerations for somebody, if maybe they're thinking about selling it on their own, that they could fall into?
Well, some of the tax implications really depend on the underlying entity structure itself, whether it's a corporation, if that corporation has made certain tax elections, if it's an LLC. Also, the domicile of the state can make a huge difference. As we're in Texas. Texas has a fairly unique taxing regime, whereas other states do charge state income tax, and so that can be a world unto itself. Really, one of the biggest things I see, though, and it's an interesting situation where the seller and the buyer are at odds on this particular point, and it's where a more sophisticated party could take advantage of the other party, and that's with the difference between the sale or purchase of assets in the business or the sale and purchase of the actual entity itself. Some really large considerations there and how that works out.
Why don't you walk us through that? What differentiate for us the difference between selling assets or selling an entity?
Well, from a tax standpoint, if you were to go as a buyer, you were to go buy the assets of an organization, you're walking into what's called a new basis in those entities, and the basis is really important because basis is what your depreciation is based on, and so as you buy the assets, you get a basis on the date of purchase, and that basis then becomes your depreciable basis to then offset taxable income in the future. Alternatively, if you were to buy the entity itself, you're buying the entity level, and the entity then it owns those depreciable assets, and so you're buying those assets at the basis the entity owns them in, and you're just carrying forward the depreciation. And so one of the biggest examples there in the difference would be property, plant, and equipment, which has some pretty aggressive and advanced depreciation regimes for tax purposes. And so say you were buying a warehouse with a bunch of manufacturing equipment, and the difference between buying the entity that might have fully depreciated all this equipment and buying the equipment that could be either depreciated in that year or maybe over the next 5 to 7 years could be an incredible difference in the effective tax that's paid by the purchaser or the seller.
Yeah. So let's break that down. How do you quantify that into savings? So in what scenario would you be saving or potentially losing out on an opportunity to save?
Sure. Well, so in this particular instance, let's just say, just for round numbers, you bought an entity for $1 million, and as the buyer of that entity, let's say half of the physical assets you purchased were actual identifiable property, plant, and equipment. So that $500,000 had been fully depreciated. Well, as you move forward, you have no depreciation to take against the future income. So if you are a taxpayer in the highest marginal tax bracket, that could cost you 40% of the dollar value of the $500,000. So over the course of a period of time, that could cost you $200,000 in tax that you're paying that you wouldn't have otherwise paid had you purchased those assets directly. So the difference between the identifiable value of physical assets and the value you pay for an entity is booked on your books as goodwill. There's some interesting considerations there in terms of banks often completely write goodwill off in terms of your bankability and all your financial metrics, and you can never depreciate goodwill or take it as a loss against any income unless or until such time as you are able to sell that entity to someone else. Which maybe years and years down the road, and so at the end of the day, it's causing a tax burden. It's causing some bankability issues that you may never have real visibility to with your lending capacity, and it can create a mess.
Well, good. I appreciate you sharing that with us. Let me ask you about sort of the formalities of selling or buying a business. So there's many many intricacies to it. So what are some of in terms of the formalities, what are some of the loose ends that you've seen left hanging after a transaction has been purported to have taken place?
Sure. So any number of loose ends. In addition to identifying what it is you're buying, which is believe it or not often the case when the right team is in place and an attorney hasn't drawn up a purchase and sale agreement, and there is an actual transfer of stock and certain documents that need to be in place so that you can be sure that you own something. There's I actually had someone come to me one time and explain that they had sold their business, which always makes me nervous when someone refers to it just as a business. Because that means they definitely didn't consider assets first entity.
Sure.
And so I actually had a business owner who told me he sold his business and he accepted a check for the business in the name of the entity, and he deposited that check in an entity bank account, and then he told me he sold the entity. So in effect, if what he was intending to happen happened, he took a check in the name of the entity he just sold and put it back in a bank account that he didn't own anymore. And so that's of course a concern if you're a small business owner to have you walked away with nothing.
Right.
But some of the other loose ends and this, like I said, in different states can have different implications for this in terms of identifying what is being purchased. In certain asset purchase environments, there's some considerable sales tax considerations. I know the state of Oklahoma will tax the purchase of property, plant, and equipment in a transaction like this at a full market rate, just like you're buying it in a non-business sale transaction. So, I mean, of course, on large transactions, that can add up to huge money that, if you don't have that visibility going in and you're not putting that into your modeling, that's a real surprise. There's also, I often see, and I feel like, going in and checking the details like this is important. I often see clients who've explained to me that they have either purchased a business or sold a business, and I go on the state website and I look and see who are the officers and directors of this corporation, who's the registered agent, and they're either not the person I'm talking to or people I don't recognize, and it's either a holdover from the old entity or conversely, they're still on an entity they don't own anymore, and so
so they've completed this transaction, but they haven't filed the formal documents with the Secretary of State.
Sure, and in my experience, one of the big risks there is if you're listed as an officer and director of a corporation and say that entity has a tax liability or tax burden, that's who the state's going to talk to, and that's who's at risk for that. Not to mention the other risks, to the owner from a legal perspective.
Sure. Well, great. Thank you, John. Great advice. As you know, many of my clients are small business owners. And in terms of the estate planning and retirement implications for those clients, the value at which they sell their business is of paramount importance. And so walk us through the valuation process. What are some of the key factors that you look at in formalizing a value for a business? And is the valuation of a business static, or are there ways that small business owners can do certain things to enhance or increase the value of their business?
That's a great question. The value of a business is anything but static. Any number of factors and the valuation process addresses all of these affect the value of a business. So whenever you're taking on the task of valuing a business, there's a standard scientific process we go through whereby we gather information from outside sources, we do analysis of the actual company itself, and we go through a decision process applying different metrics to different different items to affect that value and to determine a value. And so a lot of those do make a difference. And so really one of the first things with your question is, does the time frame affect the value? And the answer is yes. So as we identify a valuation target, one of the first things we do identify is, why are we doing the valuation? What's the actual date of the valuation, and the nature of the subject interest, and just some things going on with the entity and the at the time. The next thing we do is we dig into the actual company itself. We do an in-depth financial analysis. We'll do site visits, things of that nature, to really understand what it is that the subject entity consists of. And we do those things to identify what's known as a benefit stream. So at the end of the day, small business owner or an owner of an enterprise, at the end of the day, they're wanting some cash,
Sure.
Whether that's on a regular basis or some point in the future. So we identify what that is. And then after we've done that, then we really start our process of looking outside the entity. We say, we do a risk analysis. We do analysis of environmental conditions, economic conditions, conditions both within and outside the business in terms of capacity or management team skills, any number of things that can affect the business and its ability to continue to generate that income stream inside and outside. And so through that risk analysis, we develop what's known as a discount rate, which we then apply to the benefit stream as one means of ascertaining value. And so that's effectively what an outside investor would want to make on the money they invested in the property or in the business. And then we actually then go and approach some different metrics. So we, much like a home, and an appraisal of a home, we go look at the assets of the business. We look at market value in terms of other similar transactions that may have happened, and then we look at the income from the business. And so those things and what we've addressed to date, or at this point, are most all things that can be controlled by a business owner. Decisions about seller discretionary income and capital infusion to the business, or other things that are going on, all serve to affect both the benefit stream and the discount rate put on the benefit stream, which discount rates are a very powerful thing. And so you could take the same income stream and with lessening risk or lessening expectation of risk, end up with a much higher valuation metric on the same benefit stream. And a good example of this, or an extreme example of this, would be if you took a small mom and pop corner USA business, it might trade at a 1x multiple of earnings, let's just say. And you take that exact same business and you make it 100 units, and you take that company public, that same exact company might trade at 14x earning because of things that are in place with a much larger scale and the oversight there. So a lot of things that can be done to help a business get to whatever that next level of metric is for their type of business in terms of value. Then we apply those data methods, the market method, the asset method, and the income method. We often apply discounts or premiums to those methods, and so the discounts there can entail a discount or lack of marketability, because it's well proven that smaller firms have both transactional costs and just an inability to market themselves in a timely manner. And then we also at times for minority interest can apply a discount for lack of control, which of course it's been proven that owning or controlling less than a majority of a company is less valuable for a variety of reasons than owning a controlling stake in a company. And then we put it all together, and we write our report, and we ascertain the value of the company in a very understandable and identifiable way.
Thank you, John, for taking such a complex sort of methodology and making it sound like somebody like me can digest that. I appreciate that. So, John, in talking to clients and sort of generally taking the temperature of the population and in general, a lot of people are scared. A lot of people are scared about this pandemic and what it's doing to the economy. So in your opinion, what does this pandemic do to the business valuation process?
So in general, no business today is worth what it was 60 days ago. And so the reason that comes about is from a variety of things. So as we discussed, there's many things that go into valuing a business, and most all of those things are in a worse position now than they were 60 days ago. So the benefit stream is undoubtedly less than it was in terms of the income or other benefit that an owner might get from owning a business is probably lower. The various risk factors, from economic risk to maybe specific company risk to specific industry risk, are likely higher, generating a higher expected cap rate from an investor, and thereby, even on a static benefit stream, reducing the expected value of that benefit stream. And so really in every metric you look at how a business would be valued, we're in a situation of less value.
Okay. So what would you say to a client who's maybe considering selling their small business in this time?
I think it's never a bad time to consider selling your business or what a sale of your business would look like. If anything, now is a great time to pull the right team together and say, hey, let's take a deep dive here and look at, what are some of the things we've noticed as this pandemic has occurred. A lot of times, businesses appear successful and they operate successfully within fairly narrow parameters of things that they might not even be aware are affecting them. And so it's a great opportunity to say what's changed and maybe look into why it's changed, and then really formulate a plan to come out of this economic downturn into a good sale environment.
That's great. So there's a saying that every cloud has a silver lining, and so what would you say are perhaps some opportunities that this pandemic have provided for either small business owners or individuals?
Sure. Well, so small business owners looking to expand and in the fortunate position of being able to expand might be a great time to go buy some competitors. Maybe expand geographically into another area you don't currently serve, because if you are in a position to buy, now would be a great time to go look at some of those opportunities. Similarly, just as everything's on sale, there'd be a great opportunity for a small business owner who's looking to make a transfer of assets. We could kind of consider it like sweaters. Small business owner, we can consider, instead of the concept of owning a business, they own 100 sweaters. Okay. Sweaters are on sale right now. And so in addition to maybe potentially going to buy some other sweaters from somebody else who can't afford theirs anymore, there's the same opportunity to say, if within the constraints of some of the estate tax planning and the gift taxing, in a prior period you would have been able to transfer one sweater to your kid. Based on the current economic downturn, we might take a valuation of those sweaters as about 50% of what it was. So instead of giving your kid one sweater, we might, within the constraints of the state tax and gift tax law, be able to give the kid two sweaters. Almost doubling or almost doubling the gift. So
you're able to give more with an equal consequence as you would maybe 60 days ago.
That's the idea.
That's great.
Yeah.
And so for those who are maybe considering doing some estate tax planning or particular gifting to beneficiaries or their children, now might be a good time to do that.
Now's an excellent time. This honestly is what I believe is ripe for the picking for those who want to be proactive. Honestly, 60 days ago, no one would have assumed that this opportunity was here. And 60 days from now, the economy opens back up, the opportunity might be fleeting. So.
Now, John, a lot of my clients have worked for corporations for long periods of time and perhaps have very large qualified accounts, so very large IRAs or 401ks. And so there's a lot of things that converged recently with the passing of the Secure Act and having some of the lowest income tax rates that we've had in a long time. And then you add in this pandemic with the market, large percentages lower than what was 60 days ago. Would you say that it's a good opportunity for maybe those who have those qualified accounts who are thinking about doing Roth conversions? Would now be a good opportunity to do those Roth conversions?
Yeah, James, that's a great question. If a Roth conversion has been on your radar for a while and been something you're considering, now is truly an opportune time to take advantage of that. If nothing else, they're getting a 30 to 40% reduction in the otherwise consequences they would have, and assuming, if their long view is that the market is going up, then now's the time to act.
That's great. Now, what about perhaps businesses that have captured assets? What would you say to individuals in that scenario?
Sure. Well, and when we refer to a captured asset, we refer often to times where a business has an asset on its books that's been fully depreciated, and either for planning purposes, for risk management, or estate tax planning, or other reasons, would like to divulge itself of that asset. Oftentimes the tax consequences, especially if that asset is held in a corporation or some other structures, the outright sale or distribution of that asset can cause some pretty serious tax consequences. So there's always a good opportunity to do some structuring and some valuation to distribute assets. But now, like so many other things, the value of those assets has been reduced, and some of those same strategies can be put in place and reap even larger savings.
That's great. So John, for someone who's watched this and perhaps has a question that they'd like to discuss with you, what's the best way for them to reach you?
Yeah, so we can be reached at cpamorrison.com, or they'd be free to call our main line at 903-251-5100.
And John, I just really want to thank you for taking time out of your day and coming and spending time with us to convey some of your expertise. And so I really do appreciate that. And I really think that we conveyed some value to our clients and to those who are watching.
Thanks for having me.
Of course. And again, my name is James Davidson. I'm one of the founding attorneys at Davidson Law Group. If you would like to reach out to us, you can find all of our contact information on our website at yourtexaslegacy.com. Thank you very much. Have a great day.